Let's talk about high interest rates. They boosted bank profits in the most recent quarters, several of the firms jumping double digits. But could these higher rates turn from friend to foe? With continued resilience in the economy, that points to the need for the Fed to keep rates higher for longer in order to bring down inflation. While Fed officials seem mixed on whether to raise rates again before year end, investors are betting they're going to hold steady. Our next guest sees a possibility of rates going higher before we see any cuts. Joining us now, we've got John Heltman, good friend of the show, American banker, Washington bureau chief. Great to have you here with us today, John. We're going to have a lot of Fed speak over the course of today, and we got some of that last week as well. All of these things considered, are we expecting that to be more hawkish or more dovish as some of these remarks come about this week?
That's a great question. We are going to see lots of comments, and my expectation is that the Fed is going to do what it always does, and that's sort of say, we'll see, or like keep your powder dry. So I think the overwhelming expectation from the street is that there will be neither a rate cut nor a rate hike at the next meeting. But as you go further down the line, that expectation is basically that we're going to stay put until you get to maybe around June of 24, and then you start seeing a wider array of opinions. I kind of feel like, just given that the economy is still running pretty hot, despite there being very high interest rates for relatively high interest rates for quite a long time, and inflation doesn't seem to be coming down quite the way that the Fed certainly would like to see. I think it's too soon to say that Fed cuts are coming anytime soon. And given that there's so many possibilities out there in the world for things to go wrong, and because inflation, as I said, still remains stubbornly higher than they would like it to be, we could even see another rate hike.
John, if we do see another rate hike, I guess what will we then see from the bank, do you think, just in terms of what that means for their business going forward, whether or not they be able to continue to weather some of the challenges, given the fact that we have heard from some of the bank executives, Brian Moynihan today, saying that the consumer is still strong, yet we are continue to see signs of the consumers pulling back even further?
So when I'd say a rate hike, I'm talking like maybe 25 basis points. So it's just going to be, for the banks, I think it's going to be more kind of getting used to this new normal. And that new normal is interest rates are not zero. And they were zero for like all but three of the last 15 years or something. And that's one kind of environment. And now we're in a different one. And I don't think we're going back, absent some sort of major global calamity that would necessitate it. So what it means is that the fundamentals are still going to be there. It's going to the loans that you have on your books that you made prior to 2021 aren't going to perform as well. But over time, those are going to mature, and those are going to come off your books and theoretically be replaced with more profitable loans, more competitive loans that will be even more competitive in a higher interest rate environment. The challenge is around cost of funds, what you have to pay for deposits, and so far the big banks, especially the big banks, have been able to get away with not having to quite pay as much as they probably should. But that also is going to normalize over time. Consumers are going to demand more of a return on their assets.
Right. And so for what we have heard from the banks overall, where are you starting to see perhaps in the pass through about consumer sentiment here, and whether that's deposits, whether that's delinquencies, or even where they're still taking on loans here, even at this rate environment, where are you starting to see some cracks in the consumer?
So the first to go is always credit cards. When people have hit hard times, they tap their credit cards, and that hasn't. The broader concern about credit quality is a real one, and is kind of the next shoe to drop. But the concerns have mostly been circling around commercial real estate, specifically office loans, like office space loans, but also retail. Like there's kind of like a new world out there where not as many people are returning to the office, and fewer people returning to the office means fewer cups of coffee or danishes that you can sell to them on their way, on their commute, among other things. And And so like that's kind of like I think where most of the concern is, rather than sort of like over leverage among consumers generally. But consumers, the thing is, like with this higher interest rate environment, they also can get more on the cash that they are saving than they used to be able to with zero risk. They can just put it in a bank or put it in a high yield savings account and get a yield that is comparable to what they would have been getting out of the market, just a few years ago.
John, when it comes to the rhetoric that we've heard from these big bank executives, yes, they are worrying, especially when you take into account what JPMorgan CEO Jamie Dimon said last week, just about the dangers that the world faces right now, and it's the most dangerous time possibly that we've seen in decades. How do you compare that to what we heard at the start of the year? Have you seen maybe any improvement, taking Dimon's comments out of there, because there was lots of worries about just the stability of the banking sector, whether or not we would see a broadening crisis from what was happening in the regional banks. And here we are 8 months later, and the sector remains extremely strong.
That's exactly right. I mean, what a difference a quarter or two can make in the prospects of the banking industry. If you go back to March, April, the biggest and really most existential concerns were around deposit flight. Like we had something like $300 billion. I'm pulling that number out of the air. I think that's right though. There's something like $300 billion left to like banks in general, and went to other places like mutual fund or money market funds, almost seemingly overnight. And so the concern was like, will that continue? That concern seems to have been allayed. Most of the deposit levels have at the banks that we're seeing earnings from have seemed to have stabilized. That's the good news. The bad news is that the other pressures, like declining net interest income, concerns about credit quality, as I said, in CRE and other places, there's kind of like a lot less fee income that seems to be available and likely to be available in the future, with the president's sort of junk fees pursuits of eliminating junk fees. And overdraft isn't really as much of a thing now as it was even just a year ago. So like those clouds are still continuing to brew, but it seems like, especially given the earnings reports out of this quarter, it seems like banks are able to manage and kind of hack it in the new normal. But like that's contingent on there not being a new normal that they then have to adjust to sometime in the near future. And again, you're looking at concerns like commodity prices, conflicts, foreign conflicts are obviously huge in that. And also just who knows, like there's all sorts of things that you can't foresee coming that can flip the script.
All right, John Heltman, always great to get your perspective. American banker, Washington bureau chief. Thanks.
Thank you.